Good afternoon, sir. Good afternoon, everyone. We are delighted to welcome Mr. Manish Nath, a distinguished equity research analyst and portfolio manager with an exceptional track record in global investment management. Mr. Nath, sir, has over 2 decades of experience across the USA, Europe, and Asia with renowned organizations such as Capital One, Market Group, Ford Motor Company, and Tata Motors. A graduate of NIT Karnataka and University of Cincinnati, Sir has also pursued executive programs from NYU Stern, Columbia Business School, and IIM Lucknow. Sir's remarkable insights on value investing and systematic stock selection have been featured by Business Insider and the Economic Times. Sir has represented Ashton Capital as a keynote speaker at major global investment summits in Dubai. Please join me in warmly welcoming Mr. Manish Nath, sir. A warm welcome to you, sir.
Thank you. Hello, everyone. We are going to talk about how to find multi-bagger stocks. So first of all, what is a multi-bagger stocks? Multi-bagger stocks are the stocks which has the potential to go 10 times, 30 times, 50 times, sometimes 100 times also, to go up 100 times in the next 10 years. So that is what we call as a multi-bagger stocks. And for the portfolio, it is always good to have some multi-bagger stocks in your account. And we are going to talk about how to find them. I think everyone will be interested in knowing how to find them when they are in a small cap stage. Because once they reach the large cap, or when the market is completely aware of them, it is fully priced and the growth stage is already gone from there. So we are going to discuss where to first of all find, where do we try to find multi-bagger stocks. So let's say in the Indian context, we have around 100 companies with a market cap of 1 lakh crore and above. And let's say our target is to reach that level of market cap in the next 10 years, and we want 100x on that. So the starting market cap has to be around 1000 CR, right? So 1000 CR in 200 is 1 lakh CR. So I hope we are clear on that point, right? So this is the point one, that we have to look in the 1000 CR market cap range. So around, if we expand the band from 100 CR to 3000 CR market cap, we have around 2000 companies in the Indian context we are dealing over here. So in the global level, the number is different, but in the Indian context, we have around 2000 companies in that market cap range. And we need only 20 stocks, right? So out of 2000, how to go to the first stage, the top 200, and then from top 200 to the top 20. So this is a two-stage process. So the two-stage process, the stage one will be the quant part, where we are bringing the data of top 2000 companies. We will use these parameters to screen them and find the top 200. So let's say the ROE criteria of 5-year CAGR is more than 10%. I'm just giving you the rough idea basically, right? And using these parameters, we can have screen down from the top 2000 to the top 200. Now, why we are doing this? Because we can't personally go and investigate 2000 companies. It's a very cumbersome task. So we are narrowing it down. And so this is the stage one. And this is the quant part. The second stage is basically more on the fundamental side. So once we have narrowed it down to the top 200 based on this, and we will look into individual companies, look at their offerings, look at their annual reports, what the management has done, what are their future plans and their order books and so on. And based on that, we will try to find in our circle of competence the top 20 companies. Okay, and we will create an equally weighted portfolio, and we will have something like this over there, and we will create an average of this and call it as a super stock, as we can see over here. So the PE is going to be the average of all the 20 companies in the portfolio at that time, and we will name it as a super stock portfolio, and we are going to monitor this. So instead of monitoring each and individual company on a daily basis, we are going to look into this on a more portfolio level, and after some time we will obviously come back to the original, to the individual companies as well. But this is how the broad strokes are. So in between 2012 to 22, these are the findings of this stock selection process output. So some of these companies, as you can see, have kind of gone up more than like 100x, and now the thing is that we are going to kind of discuss in detail after this in more like a question and answer format, where you can ask me all these questions on these slides which we have discussed. And this is like the broad overview. And as you can see in this case of, let's say, Poshak, on the right hand side, you could have invested in the entire journey over the 10 years and still made money because the stock was kind of going up. So this is the advantage of getting early into a multi-bagger stock, because you can still like the stock price can go like 5 times, 10 times, 20 times, and still you like the destination has not reached, right? The stock is just keep on going up. And the key to is that we have to find them around 100 CR, 1000 CR, 5000 CR kind of range. And there onwards, we can be a part of the entire journey. So I hope I was able to kind of give you the broad strokes, and we can kind of discuss in detail on an individual basis.
So what is the exit strategy of this? Exit strategy.
Yeah, so exit strategy is that on the market cap side, if it has reached a very high potential, like what we were kind of initially imagining. Let's say our initial market cap of a company was around 300 CR, and if it has reached the 100x from there, so like 30,000 CR market cap, we can have an exit. So that's like it kind of depends on the fund mandate actually. So it will vary from fund to fund or like strategy to strategy, but it's a very long-term strategy. So this one I can tell. On the second part, if the stock is not performing well, we are not going to just say that okay, we are exiting over here, because these are like all like small cap, micro caps, right? So we have to kind of give them some time. Maybe like after 1 year, 2 years, they will kind of come back. So we are not very keen on exiting very frequently, because over here, as you can see, that in case if someone has kind of exited over here because there was a downturn, they would have missed out on this entire thing, right? So this is one thing which I always tell people, that in like normally in life we have like buyer's remorse. We are kind of buying a wrong thing, right? So that's part one. In the stock market, we have seller's remorse. So you can just imagine the kind of pain the guy must have went in case if he has sold at that point, right? So in the stock market, the seller's remorse is even a kind of a very bigger problem, because there are very few multi-baggers in the market. In a decade, I will say 50 to 100 companies are there which create like real wealth. And if you are lucky to have like 5 or 10 of them in your portfolio, you are kind of good to go. So our job is to make sure we are focused on the winners actually. We are not focused too much on the stocks which are not doing well, and we will give them some time. We are not just going to have like a trading this or a stop loss kind of this thing, because this is not a trading kind of portfolio, right? This is more of a long term. And for long term, there can be some problems in a particular industry. There's kind of having some headwinds, or there is something going on in the management, or something is going on in the company itself. Maybe there was a fire kind of broke out over there, some incidents, some fights among the management people. So give them some time, and afterwards, if they had the real capability, they will be on the track. So we are mostly kind of betting on the jockey, and hoping that eventually they will be able to kind of come out of that, and focus on the winners at that time. So that will make sure that we are not too much focus on a particular stock, and then we are going to kind of do the same mistake on like of a guy who has sold at that point of time and missed out on the entire rally. So we have to be very relaxed, and that is why the super stock philosophy kind of works, because we are not on a day-to-day based focus on an individual stock, right? We are looking at a super stock like at a portfolio level, so that kind of helps us. So the exit strategy, I will say, is that after 1 year we will reevaluate. 2 years is the time which we will give. If we are not seeing anything, then maybe we can exit also. But most of the time, we are not too much focused on that part. We are more focused on the seeing that where we can reallocate the capital, because we are anyways going to sort in the descending order of the performance over the next year. And if the company is in the top 60%, then only we are going to reallocate. So let's say if a company was 5% of our portfolio, so like 20%, like 20 companies into 5% is like 100, right? So 5% of the portfolio, and if the stock drops by 50%, so now it's like 2.5%, right? And our portfolio will double in the next 2.5 to 3 years based on the past performance. We can say that, let's say we have a decent, not very, very kind of bull run, not a bear run, but on an average, 2.5 years, let's say the portfolio doubles. So the allocation of that particular stock is now down from 2.5 to 1.25. So let's say we have 5 of these 1.25 kind of stocks, right? So that's like around 7.5%, roughly in that range. And we are not too much bothered about that, because that's not taking too much of our capital anyways. So one fine day, we may not be very happy on that day, and we will say that okay, we are going to sell all this. But they will eventually actually cancel out, because some of the stocks, they will come up, some of the stocks will keep going down. So it's like plus theta minus theta. Some of the guys will be having like technical background, they will understand. So they will kind of cancel out. And so we are not giving our positive energy over there. We want them to, we are just looking at the top 60%, because that's where our real multi-bagger is there. So we are focused on that. If we just start focusing too much on that part, then we will lose on that, right? Because we have limited amount of positive energy. We can't give it to the negative things, I don't think. So I hope I answered your question. Yeah.
And how to evaluate them? Like I do it today, for example, I do the screeners and I do start today. But we have had a huge bull run from 2020 and now it's 5 years. So in the next 5 years, we may not have that. So how do you evaluate these companies?
Yeah, so that will come with almost 5-10 years of experience. So it's not that I can give you some numbers that based on that you will become an excellent investor tomorrow onwards. So as I said, every person has their own positive, own negatives, right? So you start investing, and based on that you will get the feedback from the market, and then you incorporate those parameters, those learnings into your next round, and that will tell you. So let's say if you kind of invested in a company with a huge amount of client concentration, and eventually that company kind of went bust. So then you can understand that like next time you are not going to have a very good kind of view on those kind of companies which have only like couple of clients only, right? So that is, these are kind of, and let's say the company had huge amount of debts and they kind of went under because of the debt. So you will understand that okay, like it's a problem, and so on. And then on the positive side, if your portfolio company is doing extremely well, then why they are doing well? Why? What are the things which are kind of going for them? So you learn from there. So you use a positive feedback loop. So you add those qualities of your multi-bagger in your portfolio, and you remove qualities which are not doing well. And then from there, eventually, after 5-10 years, you will become a better investor. I won't say like the best investor, but at least from the current day till then, if you are using that feedback loop, you will have a much more better criteria at that time. So it will come with experience. It's not because it will depend on your experiences also. Yeah.
Hello sir, this is Srinivas.
Hi.
So I had heard, so I did my internship in investment banking in mergers and acquisition. So there was one analyst, he used to say that in future the equity research part will be taken care by AI. So there would be no scope for equity research. What is your take on that?
So on AI part, I will say there is a lot of talk going on among the value investing community and the investment community in general. So what happens is that there are, as long as AI is not stopping you to buy these companies early on, and the edge of the AI is speed, right? It can do a lot of calculations and at the same time, and then yeah. So as long as they are not stopping you to buy it at 100 CR, at 1000 CR level, a decent multi-bagger. So the AI has also an ability to kind of find this at an early stage, and then they will have to also sit. So the speed part of the AI is useless over there. I hope I answered your question that if you can find a stock early on, and AI has also found the stock, so the both have to wait for the next 3 years, 5 years, 10 years, right? So we can't do it like just because AI has spotted a company doesn't mean they are going to change the valuation overnight. So both have to wait. So once the edge of the AI is gone because of the speed, then I don't see any kind of difference. Obviously, some part of the equity research can be automated, and but to look at the numbers and understand on how to kind of perceive that particular information, like right now also, even in the last 10, 20, 30 years, there are like quant models going on. But if you are good in what you are doing, then you can still do extremely well.
Sir, follow-up question.
Yeah.
So I had like observed the market. So there are like certain penny stocks which trade in the market. So over the period of time, they have like flat returns, net profit. But suddenly it goes spikes up, and it starts moving. Maybe because of the business or something. Like how to identify those kind of companies. So suppose if you are like trying to find companies which are under 10 rupees per share. So sometimes I have seen, because initially one stock I had experimented. So initially I paid around 6 rupees per share. I had invested 600 rupees. So it went on to become 5,000 rupees like in 2 years or something. So the name of the stock was Trident Limited. It was into textile manufacturing, but it had done really well over the period of time. Now again, because of government policies, the stock went down. Like how to kind of identify such kind of scenarios.
Yeah, so we have to kind of find them where they are. So let's say a company is worth more than 1 lakh CR. Do you think that a company can still grow 100x from there in the next decade? It can still grow 100x, but it will take like a couple of decades because the early stage growth happens. That happens around 100 CR to 10,000 CR. So that's the fastest 100x one can get. Is that what? Okay. So when you say in terms of like market price, I am more focused on the market cap. So market cap is where we can see that okay, this company is small, this company is micro, this company is nano.
Maybe around 600 crores.
600 CR, right? So around in that range, this is like micro cap stage basically. So if we are looking at 600 CR company, we have to be sure that the company doesn't have too much amount of debt, too much amount of risk, too much amount of pledging is not there. Then we have to see whether they have their past track record. So from 60 to 600, how they have done in terms of their profit margins, are they stable in terms of their revenue growth, their sales growth, and their valuations and their other metrics, right? So we have kind of discussed on the broad strokes, and then you will have to evaluate the management on whether they have done what they have said in the past and are they on the right track or not. So it comes with experience, I can say that, but it's not extremely hard. I can say that you can have a range of parameters and start with like 30 stocks, and then based on the performance of those stocks and see which stocks are kind of growing in a very nice manner, and use those qualities in your future runs. And the stocks which are not doing well, just try to see that what went wrong in your initial thesis, and you cannot remove that from your framework, and that's how you will evolve actually. So it's not that like one fine day you will sit and you will have all the multi-baggers in your portfolio. It's a process actually.
Hello sir, I am Vikas.
Hi.
So as you can see, many small cap mutual funds are giving around 33-34% annual CAGR for past 5-6 years, and some are giving around 25% for past 10 years. Why don't we invest there itself? Means rather than taking risk on our own, investing in individual stocks. And also, do you think the same growth continues on those mutual funds in coming decades?
Yeah, so from 20 onwards, since May of 2020 till like November of 24, these 4.5 years have been very good for the uh, Indian stock market, right? In the last 1 year, in the last like November 24 till now, market is flat. It's like sideways. So to answer to your question that whether one, I think it's a two-part question. I think one is that whether an individual should go on their own or hire a mutual fund manager, right? Or go with any particular funds. Or and the second is that like, whether the market is going to kind of continue, right? I think these are the two questions.
Yeah.
So the first one is that in India we are we are in the like right now the GDP is around 4.5 trillion, right? And it's going to go to like 45 trillion in the next 30-40 years, right? So the stock market is also going to follow that. So stock market is around let's say 4.5 to like $5 trillion in terms of the total market cap. The market cap is going to go from 5 trillion to let's say 50, 60, 70 trillion. So let's say 70 minus 5 is like 65 trillion, right? It's going to be added in the next 30, 40 years. And 65 trillion means like 65,000 unicorns we are talking about, right? Like the total kind of in terms of companies. And we have right now around 500 companies with that kind of leverage, right? In the India, like both in the private and in the public market. So you can see that from 500 companies to like 65,000 companies are going to be added. So just think that the kind of potential we are seeing. So India is that hotspot right now for the next 10, 20, 30 years. So there is a lot of growth. There is no doubt. Don't go on the daily negative things coming up and all that. So just invest. Like last 30 years, the market cap or the GDP was around 450 billion, and it has gone like 10x in the last 30 years, and similarly is going to be happen in the next 30, 40 years as well. So I think the second part is done. That yeah, your investment should be there. Don't worry on the and it's a kind of a cyclical market, right? It will go up and down like sideways and all. So don't worry on that. Just keep on investing. So that's the second part. With what kind of mutual fund to grow to kind of go with is a like a personal call whether you want to do it on an individual basis or with a fund manager.
Yeah. So basically, should I go with investing in individual stocks or should I invest in directly in
Yeah,
mutual?
that depends on your interest, whether you want to kind of learn something, whether you are comfortable outsourcing and focus on your own work. So people do both. So some people have some spare time, they will kind of go and review, and they have an interest also, right? So they will go and kind of learn from fund managers or like from the successful investors, and they will kind of use some portion of their portfolio to kind of manage on them on their own. And the second is that they will hire fund managers, they will go with the mutual funds, they will go with different kind of schemes and so on. So it's a personal call. It's no there is no right or wrong in that. If someone is not willing to kind of give this much amount of time, then they should outsource. If they have an interest and they want to learn and they want to have something for their spare time, then it's a very interesting field because something is happening on a daily basis. But then you should have a very fine line between like there's a very you should not kind of cross that of your total savings of your total portfolio, you should have a line that okay, I won't gamble with or invest with more than this particular thing. Why I say gamble is in the beginning when you are not sure, then don't go with a big number. Once you have a feedback process, once you have some track record, then you will learn that okay, this much I have. Whether I can do this on my own, whether I have the timeline or time to kind of devote in this particular area, and so on. Yeah. So it's very very personal choice.
So since we are talking about multi-bagger stocks here, what are your thoughts on holding stocks of a company that is currently under insolvency and is trading at around 2 to 3 rupees? What are your thoughts on that?
So they have reached there for some reason, right? So now the thing is that whether they will be able to navigate the storm and kind of come out of that. And if we are able to find good companies which are showing decent amount of growth, then do we really want to go over there? If we are able to find some companies which are showing a good CAGR over the last 5 years, 3 years. So we should kind of go with them. And with that particular thing, it requires very different. It requires different kind of skill set. You should be able to. And over there also you can create a basket of stocks. You can have some basket of stocks and then see that where there is a movement going on, and then based on that you can do. But is that something to kind of I will start from there? No.
Sir, is it necessary that while choosing a multi-bagger stock, we have to look at the market capitalization of that company and only choose those companies which are less than 100 crore? Do you think
no,
any company which is around 5 lakh crores could potentially be a multi-bagger?
So historically, what we have seen is that large cap give around 13%, 13% CAGR over a decade kind of timeline. Mid cap gives around 18%. Small cap gives around 25%, right? And the micro cap gives around 30%. So that's based on the market cap only, right? Because once the company grows above 10,000 CR, and in your case you are sort of talking about 5 lakh CR, the company can still grow 5x, 10x from there. But expecting a 100x from there is not easy. They can still go, right? We have some examples right now. We all are aware in the US market that companies are just kind of trading at a very high valuations. So we can't say that we have no examples of that kind, but they are very rare. So on an average, I will say that in the 100 CR to 3000 CR market cap range, that's what we kind of discussed initially. That's where in the micro cap, small cap stage, there is a potential to get a 100x. And as the market cap grows up from 10,000 CR to 1 lakh crore, there the growth actually starts coming down, because you are talking that a huge giant is coming, and then to take the market share, because you need more force, you need more product lines, more services. So it's not that easy basically. It becomes tougher actually. So that's why I said, like, if you see the case of Infosys or any software company or any company coming from Karnataka, we are in Karnataka. So let's say in early 90s when Infosys got listed, the growth rate of that company in the first 10 years was extreme high. Then in the next decade, it fell a bit, and then so on, right? Because the market cap kind of device, because you were initially like a 100 people company, then you were like a 1,000 people company, then you become a 10,000 people company, then and so on. So it's very hard for the management to to kind of grow that level of that size of a company at a very high rate. It's not possible actually. Some people are able to kind of do it, and that's where we come in picture, that try to find them. But what I have seen is that after 10,000 CR, after like 1 lakh crore, the growth actually kind of goes down. In my own experience, what I have seen is that in the first 3 years we can get it 10x. So let's say I found a company around 150 CR, it went to 1500 CR in the next 3 years. Then from 1500 to 15,000, it will take 7 years. The same company with the same management. So because managing a 150 CR company is comparatively easy compared to the 1500 CR, and then 15,000 CR is a different ball game altogether. And then we are talking about, like in your case, you are talking about 5 lakh crore. So just imagine the kind of size of the company it's going to be at that point of time. Now you will say that why then people are not looking into this, right? Why not everyone? Because there are so many companies. There are like 2,000 companies in that market cap band. And to kind of narrow it down from the 2,000 to the top 200 and then to top 20, I have to devise a entire process for that, like the stage 1, stage 2, like the quant and the fundamental part, right? So there's a lot of data mining required, a lot of valuation knowledge, expertise required, lot of understanding of risk, and so on. So that's why most of the people you will see, they are investing in like well-known names with a market cap of more than like 30,000 CR and so on, because they are very well researched. There are so many people following it, so many people tracking it. But the significant alpha is gone at that point of time. There is still some alpha in some of the companies. There are outliers everywhere, but the major growth on a generic basis happens in the micro cap to the small cap to the mid cap range. So that's where we are focused on. And as I said, like the large cap on an category level itself is also kind of 13% to kind of begin with, and then your mid cap is around 18%. So why is that happening? Because of the market cap. Because the large cap means large companies and so on. Mid cap means like a medium size. Small cap means small companies. Micro is even smaller. So it's like I always give an example. So the child, if you see a child, the height acceleration is in the initial few years, and then it saturates around like 15, 16 years, right? Then your height doesn't grow, your weight grows, right? So the same happens with a company also. So the initial 1, 2, 3 years to like 13 years, like that 10 years, you can expect the child to grow from here to here, right? And after that, the saturation hits basically. So the same thing happens with a company. So what I've seen is that from 100 CR to 10,000 CR, that 100x is the fastest actually. So still the company from like 10,000 CR can grow like 100x, but it won't take 10 years. It can take more than 10 years. So that's the thing.
Sir, like how do you deal with the completely unexpected situations like Trump tariffs and all? Like sometimes you see the stock at minus 60% the level you bought it. So do you average it out or do you just leave it?
Unexpected things will always happen in the stock market. So you have to be very, very cool about it. You will have something going on every now and then, whether it can be ABC or some XYZ or something like that, right? So we are not too much worried on that. We are focused. We know that the management will be kind of, if they are one of the going multi-baggers, they will be able to navigate it. So we have a captain on the ship, right? So if the captain is good enough, they will navigate. And the way we are kind of comfortable is that we have invested in these companies and we are going to kind of give them ample time. And every 3 months, 6 months, we are going to evaluate that how is the performance kind of coming up, right? Of these stocks. But on a daily basis, are we kind of worried on a given policy change? No, it's not helping us in any way, because every now and then we will have something. But one good thing about investing in the small cap is that there is still a lot of room to grow, and they are not very much dependent on the global macro factors, right? If you have a niche in a particular segment, so from growing from 100 CR to 1,000 CR in the next 3 years, it should not be a very big challenge for you, irrespective of what's going, because it's a very big ocean we are talking about. And over here, we are like, when we are talking about 100 CR, 10,000 CR, it's a very drop in the ocean of the total global equity market. It's more than 100 trillion. So
Okay, like if you see a stock of minus 50% the level you bought, so would you plan to buy more?
So that is a subjective question. We have to kind of look on a case by case basis. But usually what we are looking is that our some of the stocks in those top 20 or top 30 stocks, some of them will be doing extremely well. So we are seeing that, okay, whether there is a trend over there or not. Now, the way we have devised is that in the top 60%, in the descending order of the portfolio performance of those stocks, we are going to reinvest in those top 60 stocks. So if the stock has come in the bottom 40%, we are not allocating at least at that point of time. In the next year, when the things subside and something is kind of coming up rosy over there, and they again come back to the top 60% in the second year, then we may kind of think about it. But we are not going to kind of catch falling knife in case if the stock is going down and keep on going down. We are not too much because we have some good multi-baggers anyways in the portfolio. So we are not too much bothered about some stocks going down or anything. So as I said, like Some stocks will go up, some will go down, will keep on going down, they will kind of cancel out. So we are not too much bothered on that. Main goal is our positive energy is focused on the stocks which are going up. And are we able to capture, are we able to add on to every stage? So let's say we found a company at a 300 CR, we should be able to reinvest around 1000 CR, around 3000 CR, and so on. If the company's goal, if the company's eventual goal or destination is like 30,000 CR, we should be a part of the journey for most of the. It's not that we just invested once and then we are not reinvesting. So we are focused on those kind of stories. If a stock went from 300 CR market cap to like 150 CR, we will give them some time. We won't exit with them. But the company has to show the positive traction.
And sir, according to you, which sector will deliver the most multi-baggers in next decade?
So I will say that there are many sectors going on. Solar is one of them. AI tech is always there, and energy. I will say consumers durable in the Indian context. I think India is full opportunity. So we don't have to kind of worry too much on a particular sector on this thing. But the valuations have to also make sense. So there is a balance. So if a sector is very hot, then obviously the price to earning of those particular companies are going to be very high. So we have to have a balance that whether the PEG ratio is kind of justifiable, like the price to earning to the growth. We should not kind of pay too much excessively for an extremely good company just because it's in the right sector, right? Otherwise, what will happen is that if you have paid too much, then the future expected outcome is going to be not that good. So that's on the valuation part, which will come with experience. So,
Sir, and what's your point on AI, hype of the AI? So do you think it's a bubble which is going to burst? Because the Nvidia, recently it got a valuation of 5 trillion, which is even more than the whole country, India. So do you think it's a bubble?
well, I will say that there is going to be some winners from the AI boom as well. Like in the 2000, there was a software bubble kind of building up, right? And it burst. But Amazon kind of came out of it. Google came out of it. So there will be some winners from this as well. And obviously that on a hysteria level, whatever is going on won't be there after some time when that has kind of balanced out. But these kind of things will always happen. Whenever there is a hysteria, all the investors are following the trend, and you are getting funding, you are getting capital for your company, and there will be some excesses all the time. This is like the human nature, so we can't help it. So.
And my final question, sir, what do you think about cryptocurrencies like Bitcoin and all?
Yeah, so that is hard to value. So I'm not against this. I'm not for it. It's in a particular company, we can evaluate it, how much cash flows are going to be generated in the next few years, and based on that, we can do some valuation and have some idea. It's not an exact science, even at that level as well, even in the company level. So if we are in the commodities cases, in the precious metals, and in this crypto area, I will say that it's hard to value for someone like me. So for me, it's a pass, but if someone can figure it out, I'm okay with that.
Sir, my question was that let's say we bought some stocks, and what happens is after some time the growth is exponential. So what would be the best decision to remove the stocks and take the money, or keep it and risk it, okay, it might increase tomorrow or it might decrease.
So you can like depending upon your confidence in that particular company, what you can do is that you can take some portion out and just stay invested, and then see the financials, see what the company is really doing. Is it like a hype? Is it like a one-time kind of thing, or it's a sustainable growth happening? Like they are able to do the capex in the future also. Their order books are real. They have some plans on how they are going to service that order book in the future. So based on that, you will have some idea. and then after a few months, after a few quarters, you can reevaluate. And then if you are not comfortable, then obviously you can take out your investment from there and keep the gains with you before it comes down, in case if that's what you are kind of asking. Yeah, but you can do it in like several stages rather than just going it like all in once.
One question, sir.
Yeah.
So recently gold is doing well, Bitcoin is doing well, real estate is also doing well, and silver is expected, it's already doing well compared to last year, and it's expected to increase by 2x to 5x nearly. I mean, let's say in 18 months to probably 2.5 years. So we have so many investment opportunities out there. Now let's say a person knows only SIP in tech-based companies or SIP in pharmaceutical companies only. Now, how much percentage of his portfolio investment must include SIP in tech oriented company or pharmaceutical, or let's say energy based company? Now, apart from all the other investment opportunities, how much percentage of his portfolio must include stock market investments?
So it's a personal choice. For everyone, it's kind of different. So I can't give a like a one kind of answer over here that okay, you can have like 20%, you can have 80% in the stocks. So it will vary depending on your own likability of if you are more interested in understanding the stocks, understanding the portfolio, understanding what's happening in the stock market. So a person can have a higher portion in the stock market if they have a decent amount of understanding, and or they can have like a 20% kind of a fixed equity, 20% in precious metal, 20% in any other category of or asset classes. But there is no one solution fits all kind of this thing. It is very on an individual level. So someone can have like 80% also invested in the stocks. Someone can have only like 20%. But at least some investment should be in the stock market. At least like given like you are sitting in India, 30, 40 years down the line, you will look back and you will see that okay, that 4.5 trillion GDP has gone to 45 trillion, and now the stock market from 5 trillion has gone to like 50 trillion. So you have missed on a very big boom. So that from that angle, you have to have some exposure. How much exposure is your personal appetite, and how you want to invest it. That is also like as I said earlier, it is like person to person depending on how much time they want to invest. So you start with some wherever you feel that you are kind of gaining some more interest, you are getting some more traction. You kind of add more on those themes.
Hello, sir.
Hi.
There will be some situation where everything will look fine on paper. Some stocks will have very good revenue. Fundamentals will be strong, but suddenly it turns out to be scam. So the stocks will go down, like obviously. So how to deal in those kind of situation? How to evaluate? How to choose those stocks? Like how to be cautious while choosing those stocks?
So as I
For
said
example, there was
Mhm.
like Gensol Engineering and Miston Food.
Mhm.
That turned out to be scam while doing very well in terms on like paper.
I think this will, you will just, you will just keep on kind of learning on these stocks basically. So in your investment journey, you will come across many stocks which will do these kind of things as well. This can be in your portfolio, in your friend's portfolio, or in the market. You will see that okay, well-known company has done that. But I have always said that for every Satyam there are 100 Astrals. So Astral is one of the very big wealth creators in the past few decades, right? In case if you follow it. So for every Satyam, and it came around, it IPO'd around the same time when the Satyam boom, Satyam bust was kind of taking place. And what happens is that people focus too much on the negative news. One Satyam news will get a lot of coverage, and then 100 Astrals you will kind of ignore because of that thing. So don't go with that mindset that okay, that a company is not going to kind of do well, right? Like right now on paper it's doing well or whatever it is. Now to answer your question, how you can save yourself from potential, Not 100, it's not 100% proof. Something will happen 1%, 2% in everyone's portfolio once in a while. But the best way is to go in a systematic way, go in a process-oriented way. That okay, these are the criteria. So what I have found is that companies with lot of debt will have these kind of issues because there are two things going on. One is that we don't know what that debt is used for, what that capital is being really used for, right? And that's a sign that something is not right or like perfect with the business model also, because and there may be a reason for that particular company to take on lot of debt and still do well. I'm not saying that all companies with debt have a problem, but it's not a process that which we will like to follow to have more debt on a portfolio level. In our case, if we are getting a company with less amount of debt, let's see in the case of Astral, without too much amount of debt or without any debt, actually they were able to kind of grow from 100 CR market cap to like a 30,000 60,000 CR market cap. We are focused on finding those kind of bets. So I hope it's clear that if there is a company with that kind of story and there is a company which has lot of debt and can give me a 100x, I will prefer the Astral one because I don't see any debt over there. So debt can be a very big indicator that I'm not saying that all companies with debt have issues, but I'm saying that we have to play very safe. So the risk management starts when you are going in. So once you are inside the Chakravyuh, then you are part of it. So once you are entering the Chakravyuh, then you have to be very clear that okay, whether I'm entering there for good or not, whether I will be able to come out from the other end or not. So if we have too much amount of debt as a habit, we are in trouble. Eventually something will go wrong. Then happens in the Indian context, there is a pledging, how much stocks have been pledged. So if the pledging is very high, then we are not interested. If the pledging is actually there, then that's also we have to understand that why we are investing in this particular company. There has to be very good reason. So these kind of markers you can have. If there is a client concentration risk, that you have to kind of understand before you are entering a stock. And we have to choose from the best of the best. So as we were kind of discussing earlier that we are going from 2000 stocks in the market cap range of 100 CR to 3000 CR. Out of in the stage one, when we are left with the top 200 stocks, after that from 200 to 20 is a very tough process actually, because every company is very good. So we are kind of selecting the 20. At the same time, we are leaving some 20 stocks which will become the multi-bagger, but they are not meeting our criteria. I hope you kind of, so it's not that like all 40 companies, all 60 companies which are going to be the multi-bagger among them, we are able to kind of have it in our portfolio. We are leaving it some other, we are leaving a lot of multi-baggers on the table as well because we are not understanding it. We are seeing some kind of risk. But we have some very clean companies, very nice companies, and why will we go with the company with huge amount of debts, huge amount of pledging, with client concentration risk or something going on with some corporate governance issues in the past? So we are not going over there. So there is a fine line which we have to always make sure. But this will come with experience that okay, you can see that a company is going to be multi-bagger or not. Based on your like 5-10 years of investment journey, you should be able to find out after like 10 years. But right now you should have a framework and use that framework on a monthly basis, on a yearly basis to see where your stocks are doing. So if your stock has grown, then try to understand why what's working in their favor, and if the stock is going down, then you see that what's happening over there. And then in the next round of your search, you will use those parameters, you use those learnings and incorporate that in your framework, and that's how you will be able to kind of become a better investor.
Sir, building on his question a little bit, some analysts, like most analysts in the market that do this job on a daily basis, may be able to visit the factory, talk to the management, and see these projects like tangibly on a daily basis. So my question is like specific to this universe of micro cap and small cap. A lot of times there is also accounting fraud in India. So a lot of times the balance sheet, the cash flows may look good on paper. Like Mission Foods, at one point we saw the ROCs, the growth in profits, revenues was like really good, and but still there's accounting fraud. So this, or like Gensol, could have been avoided if like some analyst must have gone to the factory and there was no factory there. So these things sometimes on paper, if like I have experience in the market, I know what to look at, but still like in this universe, usually those kind of things become shady, but an analyst may be able to visit and see these tangibly, talk to them and get a better feel. So my question is, you as an expert or some analyst who like can go and visit and do all of that, may be able to like make a better call, but us like sitting at home, maybe we have all the knowledge in the world, and on paper we see that everything works out. Do you still think we should enter into this universe of 300 cr or 500 cr?
Yeah, it's a personal call whether you want to invest that much amount of time and kind of have an expertise in that particular area. It's a personal call. If you like the stock market, if you want to understand what is a multi-bagger, what so on, so it's a personal call. It's not that you can you are forced to do it. You can just invest in a small cap mutual fund where there is a mutual fund manager who is managing that and taking care of, and the entire team is there, or go with an investment fund, or so on. So it's not mandatory for everyone to be that, in case if they are not comfortable with that particular. But I think the way we kind of mitigate the risk is that even this kind of things happen with the professional fund managers as well. So it's not that everyone is kind of having lot of information and all that. Even still, we will have some kind of flaws in the portfolio, some this thing. But the good part is that I will give you one more example. So let's say we have like 20 stocks in the portfolio. Let's say 1 CR is invested in all in like these like 20 holdings, and so 20 CR portfolio, 20 stocks, 1 CR each. If two companies out of this 20 stocks becomes 100x over the next decade, and we have not even talked about what has happened in the remaining 18 stocks, right? So we have to go with that kind of mindset that okay, some stocks here and there, we have omitted the entire 18 stocks. Forget about the like 2 stocks which will do these kind of things, right? And so anyways, we are not investing the entire portfolio in like one stock, right? It's not that like one Gensol happened, one Mishtan Food happens, and then our portfolio is gone, right? So we are not investing in 2 stocks. We are investing like 20 stocks. Plus we are monitoring it. Plus we are tracking it on a daily basis, at least in terms of on a portfolio level, and then on a quarterly level, and then we will see. And then it's like this, that we will after 1 year we are going to sort it out in the descending order, and we were in terms of the performance, and reinvest in the top 60% only of those stocks. And in case something is going on, as you are saying that these 2 particular cases were very apt in your discussion, that anything can happen over here, right? But we are not going with the entire our portfolio investment in like 1 stock, 2 stock. It's a 20 stock portfolio, and I just gave you the answer that if your 2 stocks become kind of 100x, your portfolio is a 10x. So we are extremely fine in that kind of scenario. And only way to mitigate is that we have to have a very good framework, very well experienced team, and just keep on tracking it, and then based on that we will be able to get some success, some investment success from there. And this comes with experience, this comes with confidence, which you have kind of developed over the past your track record and all that.
So diversification, as you rightly said, is a strategy. Could you tell like if there are other strategies that is used? Like for example, I am preparing for my CFA right now, and there are some concepts like you decrease the beta of your portfolio or CAPM models and all of that. Do you really use these quantitative models to reduce risk in your portfolio in real life? And like if any other sort of broad, not exact strategies, but like things you use to like mitigate this risk other than diversification or like rebalancing in general?
So that's you are talking about on a portfolio level, right? On a portfolio level, what kind of strategies or tools which we are using. So yes, initially, as I said, that it comes with knowing what you are doing. Like like before entering the Chakravyuh, you should know that okay, in this particular this thing. So my thing is very clear that okay, out of 20 stocks, if two becomes 100x, we are good. So that's the like we know what we are doing kind of thing, which has kind of developed over the past 20 years, right? So, but for every fund, they have their own strategy. They have their own team for that particular understanding of the cap and what you are saying that models using those kind of tools for the mitigating the risk and all. Everyone is kind of different. It depends on what suits you actually. But what I have seen is that on a stock level, if you are going with a company with less amount of debt, you are in the safer area actually. So that's like one of the findings which I have, and but this will come with experience. Plus, you have to make sure that you are not paying too much for a particular company. So let's say if the PE was like around 100 plus, and you have already kind of paid, so you are not expecting too much anyways. So the valuation knowledge has to be there. You have to see whether the profit margins are stable or not. So all these things can be still there are ways which companies, as you mentioned, have kind of done that okay, it will still kind of filter through, and eventually they will go bust. So, but as I said, if we have a good process, it will make sure that we have at least couple of them, couple of 100x in the portfolio, and they are the one which will take care of the entire thing. So we are more focused on them. We are not focused on what can go wrong. Anyways, because when we are entering, the process is so good that we are avoiding most of them. Like as I said, when we are coming down from 200 to like top 20, there are companies which we know that they are going to be multi-bagger, but still we are leaving them because of some of these kind of risks which you have said. Like we are not very much comfortable with them, with that particular the experience of the management or something we are able to. So there is a sixth sense which kind of develops over a period of time, which you can say that okay, everything adds up, but still something is not right. So then we will leave them because we are going with the creme de la creme. And why we are going to take any risk? And plus we are not allocating all at once. We are allocating in stages, right? And then that too based on merit, and that too. So how we can go wrong? And the best part about India is that it's going to grow from here to the, as I said, like 10 times in the next 30-40 years. So there is so much amount of room to grow for the companies, for the new companies to come in, that it's a mind-boggling kind of growth is still there. So
Sir, what percentage of our income should go into equity?
yeah, this is a very similar question which I have already answered. That it's a personal choice. It's your own appetite. You should start with a small amount, and then you see that okay, how much success you are kind of going to get, you are kind of getting, and so on. And based on that, you keep on adding. So don't go with like 80% of your net savings into the stock market in the first go. Go with a small amount. Then once you have some track record, once you have some idea, once you have some confidence, then you start gradually increase that. I will say that start with the 5% of your corpus, and gradually increase to like 10%, 15%, and so on, depending on your track record. Yeah.
Hello, sir. I am Abhijit. So you told that it is a personal call to invest like in individual stocks or mutual funds. But when we see mutual funds like SBI, HDFC, they are investing in Lenskart IPOs at a absurd valuation. So how do we trust a mutual fund manager or that they will act on the interests of the clients rather than their own interests or their company's interests, and they will provide the best value for. So is it should we not invest in individual stocks rather than trusting our money with the mutual fund manager that we personally don't know?
Yeah, so I won't go in like specific fund names or anything. I will just give you like a generic answer that uh, like fund managers, they have the responsibility to deploy capital, right? And to the best of their knowledge, they try to invest in companies where they see there is going to be future growth. Now, sometimes what happens is that they are not able to kind of communicate it in a way that the normal retail audience can understand that okay, that this company can still be a good bet despite a good valuation. I'm not talking about that particular stock which you have kind of mentioned, but I'm talking in general that there can be a communication gap between what they are seeing and what you are seeing right over here. So don't worry too much on that. If you have seen the good track record over the last 5, 10, 15, 20 years, these are very big names actually, which the funds which you have mentioned. Several of our Surathkal alumni work over there, and trust me, they are very smart people. Okay, and don't feel that if one particular stock idea they have picked is not good as per your understanding, they are doing a bad job or not. It's not like one thing. As I said, like out of 20, like 2 stocks can do well and we are still golden, right? So if couple of them are not doing well or not going to do well as per your understanding, don't worry too much on that. We have to look at the portfolio level, what they are able to kind of generate. So I think don't focus too much. But as I said, I think it's a very challenging exercise. Like everyone in this industry, which I have seen, is that they have a mindset that they want to kind of prove something. That okay, I am kind of better than this. I can beat this fund. I can beat. So if that kind of competitive skill or kind of spirit is there, you should try for investing on your own. And it's not that stock market is very tough or requires very high IQ, or it's not like that. Like for kind of getting a very exceptional kind of returns, that's a different story altogether. But to get a decent returns like a 15-20%, I think everyone in this room is kind of capable of kind of getting that over a period of time. So don't worry too much on that. But it's all about whether you want to devote that much time, because on weekends also you will be kind of hooked to the computer and you will be working, and your family will be saying that what are you doing. So you have to understand that whether you are willing to answer to those kind of questions, or you are just saying that okay, take my money and give me some kind of performance. So
I just have one last question. So let's say I buy real estate. Now that's the plot. I know that plot over there is mine. Now let's say I buy gold or silver. I know the commodity that I'm buying is a limited quantity, and I know that I hold it in front of me. But how would you explain to a layman that investing in stocks is a good idea without sounding like a snake oil salesman? Because that's something that's I've had a hard time doing that to my parents or even to my grandfathers or grandmothers for that matter. So how do I convince them without sounding like a scamming person?
So basically, there is nothing scammy about this particular industry. It's a $100 trillion plus equity markets, like the global equity markets I'm talking about. Maybe because in Indian context, we didn't had too much success stories. But now in the last 15-20 years, you can see that the Indian stock market has kind of grown from here to here, right? And there are so many success stories over here. So you can show them. You can show them some success stories over here that okay, these companies have done so well, and so on. So if there is obviously lack of financial literacy in this country, obviously we can understand that. But stock market should be a portion of your like not your entire portion of your investment, but some portion of your investment, like real estate, as you said, like precious metal, and your equity market, and then your provident, like your mutual funds, and so on. All asset classes should be covered in the portfolio, and it's some 5-year period. One asset class will beat the other asset class, right? But you should have like all four. Like when you are having lunch or dinner, you are not just having like rice, right? You are having roti also. You are having dal also. You are having some carbohydrates, protein, and fiber, right? It's not just you are just eating protein only. So it has to be like balanced. So similarly, in that way, you can just say that okay, we are kind of, if India has grown in the last 30 years from 0.45 trillion to like 4.5 trillion, it's a real thing. It's not like in imaginary. Similarly, the stock market kind of follows the GDP of a country. So from there, it has gonna also kind of gone up like 10 times in the market cap. So it's a tangible thing. Then from 4.5 also it's gonna go for like the next 50, 70 trillion in the next 40 years. So we are going to kind of miss out on that. So the stock market is not asking that everyone should be there, but whoever will be there, and if they know what they are doing, they will make some decent returns. So it's not for everyone. I have to be clear, because if a person is very much focused on the real estate, they will go with the real estate, no matter how much you explain, right? If they have to invest in gold, they will invest in gold. If they are say that okay, I'm not going to be with the equity market, it's all this nonsense and all. It's very tough to kind of convert them. But should they come to the stock market just for the sake of it? If they are sleeping like peacefully at night with whatever investment they have and they have enough, it's okay. They can go with some small mutual fund also. They don't have to go on their own, because if they are not trusting the entire sector, entire asset class, it's a big thing, right? So they won't be trusting individual companies as well. I think I can understand that. But you don't worry on that part. You have to see whether you want to invest or not. If you see that okay, there is going to be growth as we have seen in the last 30 years, then we don't have any issues.
Thank you, sir, for the valuable insights.
Welcome.
It was a very good experience, and we got a lot of knowledge. Very grateful for their time and inspiring us. Now I request Ritanjali ma'am and Suprabha ma'am to give a token of appreciation from our department side.
Thank you. Thank you.